What's up guys, it's Darren Jackson, welcome back to the channel, and today is going to be part 2 of investing terms you should know, especially if you're a beginner. This one's going to be a Lingo edition, which I really think is going to be beneficial for you guys because if you've ever been like me and you've heard people talk about stocks, whether you're watching a YouTube video or you're right in front of them, they're using terms that you don't know what they're talking about, they just seem smart, then hopefully this video is for you. And we're just going to be going over 4 terms. Again, there's probably going to be a part 3. So there's gonna be a lot more. So let's get started. So the first lingo term you need to know is bullish. And basically what bullish is... Yo, Darren. How long have you been there? I don't know, that's not the point. Look, man. Okay. I just bought this stock and it's bullish. Oh, really? Yeah, it's bullish. Oh, really? What stock is that? What stock? That doesn't matter. But it's bullish. It's like red bullish, except I like the blue flavor. I don't drink it anymore. It's got a lot of sugar, but it's bullish. Okay. All right. Well, interesting. Didn't know where he came from. But basically, bullish is when a stock is trending upwards. It can apply to a stock, a sector, or the entire portfolio. But in regards when it's a stock itself, it's when it's projecting upward, aka when the stock price is increasing. That normally happens when people are consistently buying into it, which would happen if the stock is for a company, for example, that is releasing a lot of good news or has a lot of potential for a lot of growth in the future, and people want a piece of that pie. So they're gonna keep buying in, which is gonna make the stock continuously go up, which resembles a bullish stock. It's called bullish because a bull has horns, and when it attacks its prey, it's gonna attack it and go into an upward motion, up, like how the stock's doing. So there's bullish. Now, inversely, the second term is... Oh, jeez. Oh, what happened, man? What happened? Why are you upset? Bearish now. Yeah, it's bearish. The stock, you remember when I told you the stock was bullish? Uh-huh. It's bearish. Really? It's Jay Cutler bearish. That sucks. I'm sorry. It's Leonardo DiCaprio finally winning an Oscar because he got mauled by a bear bearish. Super bearish, man. Okay, all right, man. Take care of yourself. All right, so as Darren number 2 is upset about, it's because his bullish stock is now bearish, which can be a good thing depending on how you look at it. Basically, what bearish is, it's when a stock is trending downward. And now it happened when the price of that stock goes downward, which happens because people are consistently selling that stock so they can gain some of that money, which normally would happen if people don't believe in that company or they want to just take some quick gains, or there's some news about the company that's negative, that's bad, it looks like they're going to lose money, so people want to just take money as they can before they get some type of loss and it's too late. The reason why it's called a bear is because a bear will typically attack its prey downward because a bear is really tall, so it'll slash its claws in a downward direction like the stock trends downward. So there you go. Hey man, I got a question. You're still here. What's up, man? Hey. If this stock was bullish, yeah, it was, yep, and then it became bearish, that's pretty volatile, isn't it? Wouldn't that show some volatility? Well, yeah, I mean, if it changes a lot that frequently, I mean, it went from bullish to bearish in about, how long has this video been? About maybe 5 minutes. So yeah, I would say it's pretty volatile. I'm gonna get back to my video now if that's cool. Oh, you're about to talk about that? Okay, well, don't let me interrupt. Mind your own business. All right, cool. Volatility. So volatility is how you would describe the movement in price of a stock, the sector, the entire stock market within a given period of time. So with the case of Darren with another shirt, he bought a stock that was trending upward, dramatically upward to the point where it was bullish, and then for some reason, somehow, minutes later, it was bearish. People just decide to sell off of it. That doesn't really happen. I'm not sure what he's doing, but it doesn't really matter. So that could be volatile. And volatility can work in good or bad ways. For example, one of the stocks that I talk about a lot is actually an ETF called SPHD. If you want to learn more about it, make sure you click that link up above. SPHD is an ETF that when I bought it was showing a lot of bullish trends, meaning the stock price was going higher and higher over a given period of time. But once this pandemic happened, it hit certain sectors of the stock market which are favored by this ETF. So since it had a negative impact, it dropped down and went bearish. So if you're looking at this ETF from a year period of time, you'll notice that it went up a lot and then it went down a lot. that symbolizes a very volatile stock, or in this case, an ETF. And again, volatility can be really good, it could be really bad. Just depends on what you're looking at and ultimately what you're looking for. Now, Let's go! What? You sound happy. I wasn't yelling. What happened? Oh, you mean just a second ago? Yeah. So I sold all my stocks. You sold all your stocks? You sold all of them. Why'd you sell all of your stocks? Well, I sold all my stocks because it was bullish, it was bearish, it was two different teams, the Chicago Bulls, it was the Chicago Bears, two different sports. I got confused, so I just sold it all. But, listen, okay, because I'm smart, I actually got some money out of it. Got some capital gains, if you will. It's crazy. Well, good for you, man, okay? Again, I'm gonna go back to I'm happy for you, but I'm gonna go back to this video. Oh, you trying to talk to him? Okay, go back to your YouTube, your tube views, your YouTube. Go on, go back. Let me get my money. It's called YouTube. It's $10. Okay, thank you. All right, capital gains. So capital gains is basically what you describe the profit that you make from a stock, an ETF, or whatever from your stock portfolio. So if you buy a stock at $10 a share, you hold on to it for a year, and it grows to $50 a share, that means you made a $40 profit. Now keep in mind, that profit isn't an official profit until you actually sell the stock for a higher price than when you bought it. So example, if I bought a stock for $100 and then tomorrow somehow it grows to be $1,000, then I can't really tell people I made a $900 profit because I haven't sold the stock, which will make it official. It'll put it into my bank account. Especially because the next day, that $1,000 stock could drop down to 50, which means I just lost 50. So if I sold that, then I would have a loss instead of a gain. So it's the profits that you basically take from a stock or your stock portfolio after selling the stock so you can obtain the cash from it. That's your capital gains. I apologize for the distraction that the other doppelganger made during this video, but hopefully you guys enjoyed the video. Make sure you guys leave some comments below on any words or phrases or anything that's kind of confusing when you hear about it in regards to stocks. I would love to share it with you guys, at least get my opinion on it, hopefully define it a little bit better for you. And make sure you watch some of these other videos, which I hope help you guys on your investing journey as they have in mine. I do appreciate you guys watching, and until next time, take care.